There's a lot of overlap with the stop loss orders and the order types that you're already familiar with. And we use them to control risk, and in general, they fall into the same categories. One would be a market order, but there's some blending here between pending versus a market order, but we'll cover them both. So a market order puts an emphasis, of course, on making sure that your order is filled. So that's the priority, and you have to think about, what's my objective here? Am I more concerned about just making sure that a stop loss is triggered and that an entry or an exit is made? So that would be a market order, put the priority on the fill, versus am I more concerned about the specific price? Do I want to make sure that I get a specific price or the order is not filled? And there we'd want to use something like a limit order. Now there's a third type of stop loss order that's unique, and it's a trailing stop loss, and we'll cover that as well. It's very popular. A lot of investors like to use it as a way to control their risk while they let a trade run. So if they can allow the trade to run for as long as they can and accumulate as many gains as they can, well, one way to integrate some risk control or a stop loss in that would be using a trailing stop. So let's start by looking at a specific example, and we'll just set a stop loss. Now here I'm returning to a chart that we've already seen. This is the pound. And let's say that an investor wanted to get into their position at 136.50, so right up there, but they're a little bit concerned about the amount of risk that they are exposed to. So they want to set a stop loss, and let's just assume that they set a stop loss order somewhere underneath where they originally got in. Let's assume that they've set a stop loss order at 135.50. So this means that they've put a stop loss basically 100 pips under their original entry. Now we'll talk a little bit more about risk reward and is that really worth it. That's a pretty wide stop loss, but it'll be convenient for our calculations. Now it's important to recognize here, however, is that this is not guaranteed, because once that price is hit and available, that means that the investor thinks that they probably will be filled at 135.50, but it depends on market conditions, because the priority for an order like that is to make sure that the order is filled, not necessarily that the price is absolutely met. If the market is moving really fast, then it's possible that the price that they wind up getting filled at on a stop loss order may be a little bit worse than what they had originally expected. Now it's also possible they might get a little bit better, but that's pretty unusual. So let's talk a little bit more about setting a priority on the fill price, not just on the fill. So here an investor would use a sell stop limit. Now this one can be a little tricky, so let's break it down. Again, we're going to assume that we have an investor who wanted to buy the breakout here. They decided to buy in on the pound at 136.50. And they want to set a stop loss order, so they're going to put something in underneath their position. Let's pretend that, again, they were going to stick with the 100 pip stop loss, and they set a sell stop limit. Sell stop limit at 135.50. So once again, we have a trader who set us a 100 pip stop loss, which may be appropriate just depending on their upside forecast. That is a pretty wide stop. And as you recall from our prior section, a sell stop limit is one that will only be filled at that price. So what the investor has basically done is that they have set a point at which a limit order is triggered when the price of in this case, the pound, actually gets to that point. So once the price gets to 135.50, it's going to turn this order into a limit order to sell it. Now here's where it gets a little bit tricky. That order is a separate order. So most dealers are going to treat that as its own individual thing. So if for any reason you closed a position that you were in where you had a sell stop limit on that order to protect it, well, if you had both of those and you wind up closing the order manually for whatever reason, you got to cancel this one as well. It is treated as its own thing. Now, trailing stops are very popular and they have some specific uses. So again, let's repeat our example. We've got a trader who got in at 136.50 and they may set some kind of a stop loss. Maybe they are willing to give up 100 pips. So So they've put in a stop loss down here at 135.50, but then what happens if they start to accumulate a lot of big gains? The stop loss could wind up being not just 100 pips below where they originally got in, which is where it's going to stay unless they do something about it, but they could wind up accumulating a lot of gains, which are then still at risk. The trade wouldn't be closed unless the price came all the way back through their original entry and down to their original stop loss. Now what they could do is they could modify their stop loss order. So they could just manually go in and change where it triggered. So if they originally set it at 135.50, well, they could go in and move it up. There's nothing wrong with that, of course. In fact, traders do that quite often. Or they could do it automatically. So a trailing stop loss, essentially what it does, and here let's pretend again we've got our investor where they have bought right there. They've set their initial stop loss level right here where this red line is, and they're going to allow that to automatically adjust by a specific interval that they've decided. So let's say it's 100 pips. Well, every time the price moves up by any amount, that stop loss is going to be brought up just a little bit, and it will never go down. So as the price continues to rise, that stop loss trails behind the price by 100 pips. Now, if the price comes back down, the stop loss does not move at that point. It sets a high water mark. So eventually, the price will hit some kind of a high, let's say back here towards the top of that trend, where from its high to wherever it bottoms out, it goes at least 100 pips lower, and it'll wind up triggering that stop loss, which has been moving along with the price that whole time, and then finally gets them out of that trade at that point. So a trailing stop loss, what it basically does is it allows an investor to more comfortably stay in a long-term trend. Now the hazard with a trailing stop loss, however, is that it acts basically as a guarantee that you're going to get out on a low. So how does an investor deal with this? Well, most of the time we have a stop loss in there for capital protection, but not necessarily for the only way that you would exit a trade. Most investors like to be able to decide when they're actually exiting a trade and not leave it up to the computer to automatically do it for you.